Hey everyone, and today we'll be talking about two companies that seem to have a good potential ahead based on their recent filings. So, the first one is a developing healthcare service provider that has incorporated its first overseas platform in the UAE. And the second one is in a rail systems manufacturer that has launched its third diving support craft for the Indian Navy while restructuring its shipbuilding business into a separate subsidiary. And together, these developments showcase how healthcare expansion and defense manufacturing are creating powerful tailwinds for companies with strong execution capabilities and diversified growth strategies. So, welcome to another episode of Noisemaker, where we make things simple and talk about companies that may not always come in the spotlight but have a strong potential for future. I am Saijal Agarwal, Equity Research Analyst at Desvelado Advisory, and today we'll be talking about two companies that are making solid progress in their business, and if current trends remain, they might keep growing even further. But before that, let's take the look at the disclaimer. So, any discussion, facts, or writings provided here are for informational purposes only and do not constitute any buy or sell recommendation. So, please conduct your own due diligence before making any investment decision. Now, let's move to the first company, Jeena Sikho Lifecare Limited, which is a developing healthcare service provider in India with a wide portfolio of Ayurvedic products and hospital services. Company had made a significant strategic move by incorporating Jeena Sikho International LLC in the UAE with an initial capital of AED 1 lakh, marking its first overseas platform to capture international Ayurvedic demand. And this entity comes with a valid business license until September 2027, positioning the company to tap into growing global interest in traditional Indian healthcare system. Also domestically, company has added 40-bed, 13,000 square feet hospital in Jammu, further expanding its healthcare capacity towards the FY26 target of 2,850 to 3,000 beds, with a long-term goal of 7,000 to 10,000 beds in the next 3 to 5 years. Additionally, they have entered into a collaboration with Salesforce in partnership with Quadrafort Technologies to drive digital transformation in CRM and patient engagement. Now, what's particularly impressive about these developments is how they create multiple growth engines for the company. Like the international foray will build new revenue streams, incremental bed capacity will strengthen the service delivery, and tech integration will obviously improve operational efficiency of the company. And this positions company to sustain strong top line momentum while also maintaining its guided 20 to 25% PAT margin. And also, the company is scaling its OTC vertical significantly, with management guiding for around 700 crores revenue in FY26 ex OTC and aiming to scale the OTC vertical to 500 crores in 1.5 to 2 years. Now, this asset light, higher margin growth complements their hospital business, creating diversified multi-engine model. And now Nishant will be joining us to give us more details about Jeena Sikho's financial performance. So Nishant, how has Jeena Sikho performed financially in the recent periods?
Yeah, thanks, Cesar. Jeena Sikho Lifecare has delivered quite impressive growth trajectory across key financial metrics. Looking at the revenue performance, the company has shown consistent growth momentum. Revenue from operations grew from rupees 324.4 crore in 2024 to currently 469.1 crore in 2025, representing a strong 44.6% year-on-year growth. The half-yearly trends also show sustained momentum with H2 FY25 revenue at rupees 255 254.9 crore compared to H1 FY25 at rupees 214.1 crore. On profitability side, EBITDA grew from rupees 93 crore in FY24 to rupees 124.9 crore in FY25, with margins remaining healthy around 26 to 28% range across different periods. Most impressively, net profit increased from rupees 69.2 crore in FY24 to rupees 90.7 crore in FY25, maintaining solid net margins of around 19 to 21%. The company has also seen some interesting changes in shareholding pattern, with FIA holding increasing significantly from 0.26 in Q2 FY25 to 5.91% in Q1 FY26, indicating growing institutional confidence. But Sedal, my question is, what is exactly driving Jeena Sikho's multi-pronged expansion strategy across international market and digital transformation?
Good question, Nishant. I think companies' strategy reflect a very thoughtful approach to scaling in the healthcare sector. The UE incorporation is particularly strategic because it taps into the global growing demand for authentic Ayurvedic treatments, especially in the markets with significant India diaspora presence. And this expansion will also allow them to command premium pricing while building brand recognition in overseas market. And the digital transformation through which the company is participating, like with the Salesforce partnership, it is equally important because it is enhancing companies operational efficiency in patient management and also delivering and improving the service delivery at the same time. Also, it creates scalability without proportional cost increase. So this is very important for maintaining their guidance of PAT, which is around 20 to 25% despite aggressive bed capacity expansion also. And as I mentioned, like their OTC vertical strategy, which is especially compelling because it's asset light, it's offering higher margins compared to hospital operations. So with 15 to 20 products in the pipeline across chronic and lifestyle categories, this category will create recurring revenue streams that will also complement their capital intensive hospital business. Also, the company has secured important regulatory approvals, including clinical trial approvals for anti diabetes products and GIPSA implement for cashless Ayurveda treatment, which expands their addressable market further significantly. So, Nishant, how do you see Jeena Sikho positioned in India's evolving healthcare landscape?
Yeah, I think Jeena Sikho is uniquely positioned to benefit from several converging healthcare trends. The integration of traditional Ayurvedic treatments with modern hospital infrastructure addresses a growing market demand, especially as health consciousness increases and people seek holistic treatment approaches. Their international expansion timing is particularly good, uh, uh, given the global wellness trend and increasing acceptance of alternative medicine. The combination of bed capacity expansion, OTC product scaling, and digital transformation creates multiple revenue drivers with different risk profiles. While hospital provide steady occupancy-based income, OTC products offer scalable asset-light growth, and digital integration improves overall operational leverage. Now, with management's confidence in maintaining 20 to 25% PAT margins despite expansion, strong institutional investor interest and regulatory approval supporting market access, Jeena Sikho appears well positioned to capitalize on India's healthcare sector growth while building up sustainable international presence in the Ayurvedic wellness space.
Okay, Nishant. So now let's move to the second company, Titagarh Rail Systems Limited, which is was formerly known as Titagarh Wagons Limited and is primarily engaged in manufacturing freight wagons, passenger coaches, metro trains. So the company has made significant strategic move by launching third diving support craft for the Indian Navy while restructuring its shipbuilding business into a new subsidiary called Titagarh Naval Systems. So this new entity begins operations with an order book of around 575 crores and operates from a new shipyard at Falta, capable of building 12 to 16 vessels annually up to 180 meters in length. And what makes this restructuring particularly strategic is that it allows the core rail business to remain focused while giving the naval division space to grow independently under defense indigenization tailwind. The rail business itself is showing momentum where the order book stands at 26,000 crores, including 4,000 to 5,000 crores in wagons, and the passenger operations are scaling dramatically from 12 metro cars in FY25 to 120 in FY26. Also, company is expanding its manufacturing capacity significantly with management outlining 1000 crores of capex through FY27. They are targeting production capacity of 100 metro cars per month in next 3 to 4 years, which represents massive scaling from the current levels. So Nishant, can you walk us through the financials of the company?
Yeah, certainly. Titagarh Rail System has shown mixed but overall solid financial performance, typical of project-based manufacturing businesses. Revenue from operations for FY25 was around rupees 3,867.8 crore compared to rupees 3,853.3 crore in FY24, showing stable performance around the rupees 3,850 crore level. However, there is some quarterly volatility. Q1 FY26 revenue was rupees 679.3 crore, down 32.4% year on year, reflecting the project lumpy nature of their business cycle. Talking about the EBITDA, it remained relatively stable at rupees 484.5 crore in FY25 versus rupees 489.1 crore in FY24, with margins maintaining around 12.5 to 12.7% range. Talking about the net profit, it was around 274.9 crore in FY25 compared to rupees 286.1 crore in FY24, with net margins staying in the 7% range. The company has maintained stable promoter holding at 40.5% across the recent 4 quarters. Though there has been some reduction in FIIs and DIIs holding, FII decreased from 16.3 to 9.5 and DIIs from 13.9 to 11.7% between the recent 4 quarters. But Saisal, what's driving Titagarh's strategic focus on becoming a full-fledged rail technology player beyond just vegan manufacturing?
Nishant, I think Titagarh's evolution strategy is quite sophisticated and will address the value chain comprehensively because the company is scaling up its propulsion system vertical, which already has an order book of around 550 crores, and it is targeting production of 150 traction motors per month by the end of FY26. Also, what particularly attractive about this segment is the guided margins of 15 to 20%, which are far higher than the traditional wagons or metro coaches, positioning propulsion as a new high margin profit engine. And through their joint venture with RK Forgings, they are also setting up a 220,000 wheel per year plant with an assured offtake of 80,000 wheels from Indian Railways. And this forward integration strategy will not only cut the import dependence for the company but will also secure wagon supplies, create external sales opportunity, and strengthen their control over the entire supply chain. Now, this separation of naval operation into Titagarh Naval System is equally strategic if we see that because it allows the naval division to attract its own partners, own resources without straining the parent company. While the core rail business can focus on scaling operations with planned 1000 crores capex investment. And the recent order wins also validate the strategy because they have received a 91.1 crores order from Banaras Locomotive Works for locomotive shell assembly and significantly 467.3 crores order for building two coastal research vessels, demonstrating capabilities across both rail and naval segments. So, Nishant, how do you see Titagarh positioned in India's infrastructure and defense modernization story?
I think the company is excellently positioned to capitalize on multiple government initiatives simultaneously. The rail infrastructure push under various government programs provide a massive addressable market, and their rupees 26,000 crore order book demonstrate strong execution capabilities and market confidence. The scaling from 12 to 120 metro cars annually shows how they can handle rapid capacity expansion effectively. The naval subsidiary positioning is particularly strategic given thus defense indigenization focus and maritime security priorities. Starting with a rupees 575 crore order book and advanced shipyard capabilities position them well for future naval contracts. The move into higher value segments like propulsion systems and wheel manufacturing creates better margin profiles while reducing import dependence, exactly what the government's Make in India initiative aims to achieve. With 15 to 20% margin in propulsion versus traditional vegan margins, this diversification should improve overall profitability. The combination of strong order visibility, capacity expansion plans, vertical integration strategy, and dual platform growth in both railway and naval segments make Titagarh a comprehensive play on India's infrastructure modernization and defense self-reliance initiatives.
Okay, thanks a lot, Nishan. That really helped us to understand the direction both these companies are moving in. And now let's take a quick look at how some of our previous picks have performed. Archean Chemical Industries Limited, it rose from 672 to 705, 4.9%. VST Tillers Tractors with a gain of 5.7%. Goldiam International Limited showed a gain of 11.4%. Shelter Finance Corporation Limited showed a decline of 2.8%. And Pearl Global Industries Limited showed a gain of 3.6%. Overall, a pretty good mix of gains, and we'll continue to monitor all these companies closely to see how they shape up in the coming quarters. And here is the QR through which you can access all these companies which we covered recently. And now let's move to the summary part. Jeena Sikho Lifecare Limited has incorporated Jeena Sikho International LLC in UAE with an initial capital of AED 1 lakh, making its first overseas platform to capture international Ayurvedic demand, and Titagarh Naval Systems, which has launched its third diving support craft for Indian Navy, while also moving its shipbuilding business into a new subsidiary. So that's it for today's edition of Noisemaker. If you found this breakdown informative, you can scan the QR code to read the full report, and we'll be back soon with more simple and clear market updates. Until then, stay curious, stay ahead, and stay informed.